guys, welcome to my channel. In this video, we will discuss 2 swing trading strategies to add to your trading journey.
We're entering a trade on one day and we're not selling that day. That's really it. We can buy one day and we can sell it the next day or next week or something like that. Swings really work for people who you can't watch the charts all day or you don't want to watch the charts all day. It's really cool some days when you can catch a really good swing and you can enter at close, market close on one day, and then you wake up the next day and you've hit your, you're at 50% or 30% because it really feels like you didn't have to do a whole lot of, staring at the charts, or you didn't have to do a whole lot of work for it, even though sometimes holding is hard. So it's kind of like a more laid back strategy. It's less stressful than day trading for a lot of people, and definitely less stressful than scalping. For our swings, we want to look at our larger time frames because those are going to be the technicals that we need to hold for certain periods of time. So the smallest time frame we're really going to focus on for swings, and I kind of call it the sweet spot, is that 1 hour. The 1 hour chart is really good for short-term swings. So if you're someone like, I use the 1 hour chart because I don't really like to hold positions for a very long time. You'll rarely see me or hear me say, hey, I've been in this trade since for 2 weeks now or for 3 weeks. You don't really hear a lot of that. So I really like to capitalize off of the 1 hour chart because I can try to like find a move or find some kind of anticipated setup and just capitalize off of that. And then usually the next day or 2 days later, you're out of it, just because each candle on your 1 hour chart takes about an hour. It takes 1 hour to complete. So your anticipated moves are leading into, a couple hours to maybe a couple days, and you should be at your profit target or your profit goal. So there's always a lot of controversy over like, well, I like the 4 hour or I like the daily. Both, either one is fine. You just don't need both. So I know there's a lot of back and forth of like, should I use the 4 hour or should I use the daily? Pick one and stick to it. I use the daily. It's just my preference. If you already use the 4 hour, stick to that. So the weekly is going to be a whole different ball game, just because these moves on the weekly, like on the hourly, we're saying like it may happen in a couple days. On the weekly, that anticipated move may happen, 3 weeks later, 4 weeks later. And of course, with those larger time frames, you're going to need further expirations out. Your expiration will need to be further out to make sure that you're able to capitalize off of the move that you think you see. I'll go into the expirations for each time frame later. I have like a little chart so you guys can kind of like match it up. And it doesn't have to be perfect. Really, nothing has to be perfect with any of the trading things that I talk about. It's just going to have to be somewhere close. So if I say the weekly chart means you need a certain expiration date, that doesn't mean if you buy 1 week earlier that it all falls apart. It just, we always are going to be able to pivot and adjust as needed. There's tons of indicators. These are the main ones that I use for everything. Same thing with my swings. I will say, you guys know I don't really like the MACD, but I will give the MACD a little bit of weight with the swings, especially on a daily chart or that weekly chart. So if you start seeing MACD crosses there, they kind of hold a little bit more weight than those, those smaller time frames. Support and resistance coupled with your indicators is kind of going to be like the bread and butter. So your support and resistance lines are going to be the key for understanding like what makes a good entry and what makes a good exit, because what you don't want to do is enter calls and have like the perfect setup. However, if you don't have the support and resistance, you could possibly enter calls right at resistance, or you could enter puts right at support. And what that would be is just like entering and hitting a brick wall. So a lot of people have the issue of every time I enter, price reverses, or every time I'm in calls, puts pay, or every time I'm in put, the calls are paying. Drill down and figure out like what's going on. It's your support and resistance lines. And we'll go through setting those as well. I always use the daily and the 1 hour in the case of swings. So you're going to want to plot your support and resistance on the daily chart in your 1 hour chart. Since we've been going to like new lows, I think it was Tesla this week or last week when it was like in the 170s. When you get to low prices that you haven't seen in 52 weeks or so, or whatever your daily chart shows, you need to go up a time frame. Or in the case that you're on a 1 hour chart and you need to find the next support or the next resistance, but it's not showing on your chart, you need to go up a time frame and keep digging until you can find it. So Tesla actually required some digging, because you'll hear people say, oh, there's no support on Tesla. It's like, well, that's a lie, because there is always support somewhere. You just kind of have to go find it. So if you hear people call like really low levels on a ticker, like people may say Tesla to 137 or SPY to 325 or something, is because they've scrolled back years to see what levels used to be important. And that's all that is. Find it. Never enter a trade without knowing what the next level is, because you would be entering and possibly entering at that brick wall again. So always like know how to go find your next level. Easiest to do and easiest to set up is always going to be your buy low, sell high. Buy when the premium's low, sell when the premium goes up. It's easiest to do, but it's not always as easy as people make it seem, because these are the ones that, if you've ever heard people say buy puts on green days and buy calls on red days and stuff like that, this is what they're talking about, this strategy here. It is the easiest because it's like, oh, it's a green day, let me buy some puts. It's a red day, let's buy calls. However, the hard part is, what if that isn't the top or the bottom? So if we're talking calls, or let's talk puts, because the market has been running. Because the market's been running, they've been buying puts and they've been buying more puts, and it's just continuing to go up. So this is where it gets hard. And this is where people come in there like, well, what do I do? I have January or February or even December, November puts, and I keep buying them, but the market is not. I don't understand why it's going up. This is kind of hard. So this is the least technical of them all, because you're just going off of what you think may happen. You're going off of the what goes up must come down strategy, or that mindset. And sometimes it works, sometimes it doesn't. However, what this strategy, if you're going to do that, so like let's say everybody bought some puts yesterday because the market had been running up. That's cool, but what you would need is an expiration of at least 4 weeks out. Just look at SPY's price action for the last few days. So let's say, I think CPI happened on Thursday morning here. So some people bought puts before CPI because the last CPI caused a complete dump. Some people bought puts after CPI because it's like, okay, well, market open and price jumps. Let me buy puts because this is not going to hold. Then it kept going, and either they bought more puts or they're just watching their puts like go negative. Even with 4 weeks out on your expiration, this is a pretty negative trade if you bought puts prior to CPI, no matter what. When you start to average down, that's fine. But when it continues to go up, you now have more contracts, so you're losing money even faster at this point. And sometimes this is the hard part about the long buy low, sell high strategy, because you're at the point where you're negative 50, negative 60, negative 70%, and you need to make a decision on, what am I going to do? I've already averaged down. I'm holding, I'm doing all these things. So some of the things you can do if you are in this situation where you've been buying puts and it's just not working out, you have to learn how to hedge your position. That's the one thing you can do. If you have long positions that are 4 weeks out, 6 weeks out or whatever, and I'm talking like long, not like 2 weeks out, but if you really have 4 weeks out on your expiration, you can learn to hedge your position. So what you would do is you would start to day trade in between your swing, if you can. So if you're not available, then you kind of just have to figure out what works best for you. Like, are you able to hold until the market comes back down some until you're in profit, or what? Because even if SPY has a slight red day, it may not put your long positions back in profit. And I think that's the tricky part with this, where, like I said, like this is the easiest strategy technically, because you don't really have to look at charts to see that SPY's been running up and you want to buy puts because you think it's going to come down. So it's the least technical based off of that. But, there are some more technical ways to kind of like hedge with it. So let's say you did swing puts into CPI and this happened. What you would need to do is go down to your smaller, your 15-minute or even your 1 hour, and then you can start to play calls, because what you're going to want to do is make some of your money that you're losing back. So let's say you're in long positions for like, this is just 2 days. So let's say 2 really green days happen and your long puts are getting clapped. What you want to do is try to jump in on even a day trade or even a scalp, just to try to make some of the money back. If you're going to hold them until next week or the week after, because you do have time on them. So you don't want to get stuck or get tricked out of your spot, but you also don't want to just sit there and let them continue to fall. So that's one way to do it, is to hedge it. You scalp some calls or play some calls short term. Even if you were to swing calls, if you saw at the end of CPI that SPY was still holding up really well, and you're like, well, I'll swing calls into tomorrow, that's a good enough hedge to help out some of the profit that you have lost over time or over however long you've had this, without having to jump completely out of your position to you know, you don't want to lose your position because based off of your theory that you already had that it's going to come down. So that's one way to do it, is to hedge it. The other thing you can do is be careful when you average down. So if you did enter prior to CPI puts and this happens and you just buy more because it's up, well, it kept going. Then you buy more because it's up, and you buy, before you know it, you're just spending more and more and more money, and you're putting more money into something that has not confirmed puts yet. So what you want to do, and we'll talk about confirmations and stuff later, but what you want to do is make sure that it is confirmed that it's coming down. So if we look over here, let's say here, same situation. Let's say SPY was running up and you had puts. It kept running up, you bought more puts. Instead of just buying them as it continues to go up, what you can do is wait for price to break the 9 EMA, wait for some big red candles to come in, wait for some kind of confirmation. If you have your support and resistance plotted and you're looking at puts, wait for price to break support and then start buying your puts. So wait for proper entry and then add to your position at that point, instead of continuously adding puts as it continues to rise. Because even right now, there's nothing saying that SPY is going to tank on Monday. So it might, but there's no guarantee right now. So if you don't have enough time and you're continuously adding to it, this is how people lose a lot of money. So if you ever see people that have lost $50,000, $60,000, $70,000, is because they have a theory, and the theory could be SPY is going to come down, we're in a bear market, yada yada yada. But when it bounces green, they have a hard time switching to the green side. They can't hedge properly because their mind is set on SPY coming down. But they're just adding money to it. So if they have 10 contracts and then they add 5 Thursday after CPI, and then they added 5 Thursday at close, and then they added 5 more Friday morning, and then they added 5 more Friday afternoon, then they have almost like doubled their loss instead of just waiting for a confirmation. So if you're going to hedge, that's fine. And if you're going to add to your position or average down, then you want to make sure that you get proper confirmation, or pretend you have proper entry. So wait for proper entry on your position and then add more. But in the case that you can't stomach the red, you would have to know, okay, what's a safe level for you to pull out of it? What's the safe level for you to, you know, what are you willing to lose? And that's something, you know, you want to have at the beginning of every trade. A lot of you guys know this is my least favorite type of trading. I don't do a lot of these because it's not that technical. And then there's just no guarantee. Like, even if we are in a bear market, bounces are fine. Like, it's okay for a bounce, especially if there's something on the chart that is bouncing off of. That's strategy number 1. That's my least favorite, but it's kind of the easiest if you can stomach having red days and you know how to hedge. Okay, cool. We can go to the next one, using the weekly. So all of these strategies is going to talk about like which time frame to use and how to use it. And then we're going to break down like how to read the candles to actually capitalize off of these. So the weekly strategy is for Fridays. So this is something that you go in on a Friday and you look at your weekly chart. So the weekly chart takes a whole week for one candle to form. So looking at the weekly on a Monday means nothing. Wednesday, it means nothing, because whatever happens at close on Friday is going to be how that candle actually completes for the week. So for example, I'll use SPY in Home Depot real quick on just how to formulate that theory on a Friday afternoon. Okay, so let's remove drawing. So let's pretend support and resistance is not even here. So what we have here, so on your chart, any chart, especially your daily and your weekly, the yellow line here is our 200 EMA. The 200 EMA holds a lot of weight on a chart because being under that 200 EMA is an extreme bearish sign. It's also a place where long-term investors and institutions see as a place to buy. So when price is below that 200 EMA, it's like we're in some bearish times, and a lot of times you'll see charts fight to stay above it. So basically that Home Depot, I think I played it this candle or this candle, one of these, but all I'm looking at is this 200 EMA. And the fact that I know price is going to fight to stay above it, and that's it. That was my own whole theory. That's it. So at the end of that Friday, I ended up swinging calls just because I'm thinking this looks like a double bottom, possible pattern, whatever. And it looks like price is going to try to stay above this 200. That's it. So what that happened, so let's go to the daily so we can see. And this is kind of this falls into the realm of multiple time frame analysis. So what we're going to do is we had that theory on Friday as the weekly candle was about to close. And this is that same Friday. So this is the day right here. And you can see here we have a bullish engulfing candle. So that was like a theory based off of your weekly chart, and then went to the daily and it printed a candle to kind of support that. This is also the support. I just erased the lines, but this is the support line here. So we had a bullish engulfing off of the support, which is kind of like enough, so basically with your entries, you're building a theory. So you can say if the RSI is low, have a bullish engulfing, it's closing above support. You build this theory, and then that's enough for you to enter based off of your own theory. So this was kind of how I built my theory. Use the weekly chart. It's gonna fight to stay above the 200 EMA. It's at this support level, and I have a bullish engulfing. That is enough to enter that trade alone off of that, and just to swing into Monday. In most cases, y'all, in most cases, I always say take your profit goal. Set a profit goal. Your goal 20, 40%, whatever your goal is, set one and take it. So in this case, it just gapped up. So it gapped up and it gave me something else to look at. So once I looked at it at the end of this day, because since this is a daily chart, candles print at the end of the day, that's where you get your final candle. You kind of like assess what's happening. So this now has gapped up and it closed above our 9 and 21 EMA. That's more bullish behavior. Let's call it bullish behavior. So that's more bullish behavior. So I'm like, okay, I'll let it sit because this happened. I'm going to let it sit. However, you guys know I always have a stop loss alert. So basically, if support was, let's say, I think it was like here. So let's say our support line was there. This line here also becomes my stop loss, or the low. You kind of like can use the support or go a little bit under the support. So if you see something like this, you would make this level your stop loss. So this is my stop loss from jump. From the moment I entered on that Friday, I know if it breaks below this level, I'll take my loss because my theory is no longer supported. It's dead. And really that's it. So once this gapped up, it gave us another bullish candle above these. What I would do for my stop loss is move it up here. Let's say here, at the top of this candle. And what that's going to do is make sure that you're protecting your capital. So yes, you can 100% take your profit if that's okay. But what I want to begin to teach is like teaching you guys how to stay in some trades longer instead of always taking 30%. Like I hear you. I know y'all sometimes are like, man, we take 30% and then the trade goes 300%. We take 20% and then it goes 50%. You guys want more because you have already did the work to find the trade, and what you're seeing is that you're exiting a little bit early. The issue with that is that this year's market was a take profit market. So as we ease back into like, even if I don't care if it's a bear market or a bull market, I just want easier trading so that we can set these levels like this and hold a little bit longer. So anyways, so this was Monday closed above here. So I made the stop loss there. Like, okay, cool. I'll swing it another day and see what happens. I don't know why, but HD kind of gapped up again. When at the end of this candle, I said, okay, so we've broken the 9 and 21. A lot of you guys know about the 921 cross. So by the end of this day, the 9 and the 21 on the daily had crossed, and it's now above the 50. So at this point, your 50 becomes your stop loss. When price breaks above the 50 EMA, it is an extreme bullish sign. And when price breaks below the 50 EMA, it's an extreme bearish sign. And on any chart on a daily, go and just scroll through and see how price reacts around the 50. That's actually like one of my strategies up here is using your daily 50 for entries and exits, just watching how price reacts around it. So in the case of this Home Depot trade, we use the weekly to enter it, but coupling down to the daily can kind of keep you in that trade. So we came to the daily. Now that we're above the 50 EMA becomes my stop loss. Wednesday was a red day. On the red day, I scalped some puts, but I did leave my swing because we did not close below my level. We did not close below my stop loss level. And if we had, I would have triggered a sell order and I would have just left it, but we didn't. So there was a really nice put opportunity in here. I think it was like in the morning or midday, and I kind of like scalped some puts, and it kind of made up for the profit that had been lost on that day from the swing. And I just left it because it didn't trigger my alert to get out. Next day was okay. It was really sideways for HD, which you get a lot of sideways days on HD, so that was okay. Still was what above my 50, so I didn't move my stop loss at all. I just left it. It was still in profit. This is the day that I exited. So this is just how you use that weekly on a Friday to enter. And once you get the theory off of your Friday, so this was the candle that held the 50 here. And once it held that the 200 EMA on the weekly. So this was the candle that held it. And I kind of like basically went in based off of that. And I had a stop loss set at the low of this. So if it was to break back down, I would have gotten out because I would have, my theory would no longer be supported.
Keep an eye out for part 2, where we'll discuss using the 1 hour chart for short-term swings. Don't forget to comment, like, and subscribe.